want to talk about the concept of put-call parity. Now, in a previous tutorial, I talked about the Black-Scholes option pricing model, and that model values a European call option. I also showed you in a separate tutorial how to value a call option based on the binomial option pricing model. But suppose we're interested in the value of a put option. How can we go about finding that? Well, it turns out that if we know the value of the call, we can figure out the value of the put. And we're going to use the principle of arbitrage, which essentially says that securities that have identical payouts should have identical prices. And let's take a look at some payoff diagrams here. If we buy a call option, or we have a long position in a call option, we have a payoff diagram that looks like this. For any price below the exercise price, the option is not used and you simply lose the option premium, this distance here. For every dollar the stock price goes above the exercise price, the value of the option goes up by $1. Now, what's your long position in the stock look like? Well, here I'm just going to set the price today equal to the price you bought it at. And if the price goes above S0, you make $1. Or if it goes up by $1, you make $1. If it goes below $1 below S0, you lose $1. The most you can lose is negative S0, whatever it is you paid for it. There's no limit to how much money you can make, and that's why we have an arrow, which the stock price could go to anything. Also true here of the call option. If you were to buy a put option or have a long position in a put option, if the stock price is above the exercise price, the option won't be used. Remember, a put option lets you sell at the exercise price, but you are not obligated to do so. For every dollar the price goes below X, you'll make $1 with your put option. So if you combine these two, and I've sort of used this addition sign here to say that we're going to put these two together, and you really can add them up. If you had a spreadsheet that had the payoffs at different stock prices, you could then add them together. And what do you get? You've created what we call a synthetic call option, or in this case, a synthetic long call option. It has the same payoff as the long call option. Okay, so even though we didn't buy a call here, we bought the stock and we bought a put, we have the same payout. So by combining those two things, we created this payout, or this synthetic call that has this identical payout to a call option. We need to do one other thing. We need to borrow the present value of the exercise price so we can take possession of the stock using the call option. Remember that if we buy the call option, that gives us the right but not the obligation to buy the stock at X. But we don't own the stock unless we have those X dollars. If we own the stock, we own the stock. We already have it. So noting that one fact, we can see that if you have the call option and you have the present value of the exercise price, that should equal the put option plus the stock. Okay, that gives us, this was the diagram we had before where we created our synthetic call option, and this is the call option plus the amount of money we'll need so that we can buy, so that we can take possession of the stock. All right, if we solve for P, that gives us the following equation. The price of the put option is going to be equal to the price of the call option plus the present value of the exercise price minus the stock price. This is the put-call parity relationship. Now, let me show you this in another way. If we'd like, we can look at this from a table of payoffs so that we can see that this, in fact, is the same thing. All right, if we buy the call option at price C0, If the stock price is less than or equal to X, the value of the call is 0. If the stock price at time period T is greater than X, then the value of the call is ST minus X. Now, suppose we buy the put option at a price of P0. What's the value at expiration or time period T if the stock price is less than or equal to X? It's equal to the exercise price minus the stock price. Remember that you can sell at this price, but you only pay ST to buy it. And if the stock price is greater than X, then it's not worth anything. It's 0. If we buy the underlying stock at a price of S0, then the value at expiration is just going to be ST, no matter what, whether it's above the exercise price or below the exercise price. We bought the stock at 50, it's now 75. It doesn't matter what the exercise price is, the stock price is 75. We issue a bond or we borrow the present value of the exercise price, and what's that going to be worth? Again, that's not going to depend on what the stock price is. The value of this is going to be minus X in both cases. So if you combine these two, if you take this plus this minus this, right? If you go down the line here, you get a payoff of that's exactly the same as buying the call option. Let's see, X minus ST plus ST, so the ST's cancel, and then X minus X gives you 0, so this position here has no value if the stock price is less than the exercise price. And then if the stock price is above the exercise price, the put option has no value. The stock price is worth S sub T, and the value of this bond that you issued is worth minus X. So again, it's worth exactly the same. So using both the table and the payoff diagrams, we showed that we've created two strategies that have the same payout. Okay, so again, if we rearrange terms, right, if we take this, the call option value should be equal to this this strategy of buying the put, buying the stock, and issuing a bond with the present value of the exercise price should be equal to the value of the call. They have the same payout. And again, solving for P0 gives us that same equation we had before. So let's take a look at an example. Suppose a call option with an exercise price of 55 has a premium of $4.25 and expires in 3 months. The stock price is $54.50 and the risk-free rate is 3%, okay, and a 3% annual rate. Let's find the put premium, or the price of the put. Plugging into this equation, the call option is worth 4.25. We need the present value of the exercise price. Remember, if we're talking about 3 months, we're talking about a quarter of a year, okay, or we would raise this to the 0.25 power, that's what T would be, minus the stock price of $54.50, and so we get a put premium, or a put price, of $4.34. So once again, even though these option pricing models value call options, by using put-call parity, we can actually figure out what the price of the put option is.